So the second quarter loan loss provision came in greater than what was expected by analysts. But what's really key for analysts and investors is the full-year loan loss charge. Most European banks have given that. I don't see that at the moment in your numbers. Can you give us some guidance of what you expect in terms of loan loss provisions for the full year?
For us, and we are very proud about how resilient our franchise has been. I think if you look at our revenue numbers, it has held up with our net interest income actually being quite strong. Fees are up. Our cost discipline is there, keeping our costs flat. Our capital ratio actually improved from 14% to 15%. And actually our loan losses that you talked about remain relatively modest with 1.6% in terms of loan loss in terms of stage 3 ratio. Having said that, you're right that we have taken somewhere around 1.3 billion euros in terms of charges for loan loss reserve during Q2. Now, addressing your question about what the future will bring, I think in looking at our loan losses in Q2, we have basically based it on a certain economic scenario. And in our case, for the Eurozone, for example, it's based actually on a reduction in GDP of -8% and a recovery of roughly 5.5% going into 2021. And on that basis, I think if that situation transpires, we expect that loan loss provisioning will be lower in in the second half of the year compared to the first half.
Okay, well, let's just put some context around this, Tanate. The market wants to know. I mean, you've gone from a 42 basis point provisioning in Q1 to, I think you confirmed to me, the equivalent of 80 basis points here. So this is a dramatic either deterioration or a reassessment of your portfolio. So which is it? Because you're now way ahead of your peers in terms of the deterioration. So is it that the assets are deteriorating more quickly than you thought, or are you being more aggressive in your assumptions?
Good question. I think if you look at our assumptions, how IFRS accounting works, basically there's an element of front loading of loan loss provisioning even before the actual loan losses appear. And in our particular case, in that 1.3 billion euros, approximately 400 million euros is basically reflecting the macroeconomic slowdown that you see without the actual loan loss being visible in our numbers yet. Having said that, I think if you look at our non-performing loan ratio, it's actually quite low at 1.6%, which compares actually quite favorably compared to our European peers.
On that point then, would you say that your loan book resilience is better than your peers? And why is that, Tanate? I mean, there's no reason really to think that you've got safer loans than other lenders, for example.
I think probably in two parts. If you look at our loan book, almost 40% of our loan book is in mortgages. And those mortgage portfolios are predominantly in the northern part of Europe, so in the Netherlands, Belgium, and Germany, where the performance and the economies are relatively quite strong. And we have actually quite limited exposure to, say, some of the more sensitive parts. For example, our portfolio with respect to airlines is actually quite modest. Our exposure to hospitalities is also modest. And I think the last point to make about our loan portfolio is that we're actually quite a diversified group with lending which are not concentrated in any particular sector, except, as I mentioned, in the mortgage area, which we deem to be quite safe.
Today, COVID has ravaged every industry and driven fundamental changes. Are you going to have to accelerate, or will you accelerate your bank closures? We know you as the technology-savvy bank, but is COVID going to push you to accelerate bank closures, physical closures?
Well, I think that acceleration is already happening. If you look at the last quarter, almost over 80% of our interaction with our customer base is digital. More than that, over 41% of our customers deal with us only on their mobile device. So clearly, the acceleration of digitization, a strategy that we have been pursuing for quite a number of years, is actually being accelerated by COVID. So indeed, there are, we're always reviewing our physical footprint. And in some markets, like in the Netherlands, we have announced reductions in our branch footprint. So indeed, that acceleration of digitization is happening within our industry.
I wonder what that means for cost, Tanate. Your cost-income ratio target has been 50 to 52% for a while. It's currently, according to Bloomberg Intelligence, running at nearly 60%. So is your cost-income ratio target still achievable? How aggressively are you chasing that right now?
Yeah, I think we have our ambition to get to that 50 to 52. And as a digital bank, we believe that we can get there. But of course, we're going through quite an unprecedented period of time where our revenue is under some pressure because of the economic situation as we see here today. But we do take and we always review our efficiency plans. And the fact that we are able to keep our costs flat year on year, I think, is a testament to actually reducing costs while actually at the same time investing in our future, in our digital future.
Tanate, just let's finish off with dividends. Obviously, we've got a huge review from the ECB pushing for pause. I would say pause and reflect. But what investors will want to understand from you is whether you still retain progressive dividend policy, and will you have, it's the same question for you as I had for SocGen, are you going to have excess capital that might be trapped because of regulation, but nonetheless you will have, capital to release eventually?
I think if you look at our capital ratio is sitting at 15% core tier 1 ratio, which is 5% higher than our MDA trigger. So we have plenty of room to pay dividend. We even reserve dividend for the full year 2019, which we have not yet paid. And I think once the dividend relaxation comes from the European Central Bank, we're looking forward to actually resuming our dividend payments.
And you remain committed to a progressive dividend policy?
We have put basically our dividend policy into suspension because of the ECB recommendation, and we will review our dividend policies once the dividend ban is taken off.